Alright, so we left off having just finished para 46. We're dealing with situations whereby you have to apportion what your primary residence exclusion is going to apply to. So we're never going to apportion the 2 million, but we do have to apportion what that 2 million can apply to. And para 47 over here, wherever I found my mouse, there we go, speaks about apportioning of periods where you didn't live in their house the entire time. So if the natural person or their spouse didn't live in the house since they've owned it, or since 2001 if they've owned it before, okay, you have to apportion it based on periods. So let's say you treated the house as your primary residence for 10 years, you then left it for 5, rented somewhere else, rented out your house, and then came back for another 5 and lived in it. You've used that house as your primary residence for a total of 15 over the 20 years, which means you can only apply the 2 million to 15 over 20 times by the gain. The other 5 over 20 will have to have CGT and not be subject to the exclusion. Okay, so if you or your spouse didn't live in the house for all the time. 48 provides certain scenarios whereby you don't have to apply 47. So, if the reason that you weren't living in the house was one of the following: it was your primary residence, but it was offered for sale and you left it to buy a new primary residence, or the residence was being built, or it was uninhabitable due to an accident, or somebody died. If these are the scenarios, you can treat at least up to 2 years per time as if you had lived in it. So if you put it up for sale, you moved, and it took 1.5 years to sell, you don't need to apportion. If there was an accident and you couldn't live in it for 2 years, you don't have to apportion. Okay. Sorry, just stopping a call there. What you need to speak about or think about in para 49 is if the whole thing is not used for trade or not used for residential use. So if you use some of it for trade. So let's say a portion of your house is used for a business, or a portion is used for a home office. Those parts of the house are not going to be allowed to be used for the 2 million primary exclusion. Now this apportionment is going to have to take place due to both the amount of time and possibly the amount of area that these things take up. So your apportionment calcs could start to get a little bit difficult, okay, because you may have that 10% of the house was used for trade for 20% of the time that you owned it, so the apportionment calc is going to get a little bit tough. Awesome. Para 50 speaks about rental periods. So if you didn't use the primary residence for the whole period, so quite similar to para 47, if you rented it out, okay, so you rented out the property for some period that you weren't living in it, you can deem yourself as having been resident for up to a maximum of 5 years if you lived in it for more than a year before you let it out, okay, and you lived in it for more than a year after you let it out, and you had no other primary residence during this period, and you were absent from South Africa or had to be employed or work more than 250 k's from your house. Basically what this is saying is if your work sends you overseas or somewhere else in South Africa, for a period of up to 5 years, you can rent out your house. Provided you lived there before and you lived there afterwards, you can treat yourself as having lived in that place for a period of up to 5 years. Okay. Some examples. This one speaks about apportioning for size. Okay, so based on the size of the land and the way that you do that apportionment. Note, okay, you never ever have to apportion the 2 million gain. You can only apply that 2 million, however, to the portion which is primary residence. You still have the full 2 million available. It's just what you can use it against. Okay. Think about these exclusions. Think about if you had to apportion both for size or area and for time, if you could do it. This example here that you need to pause and read through speaks about a situation where the residency was interrupted. Okay, and yeah, again, I don't think it's too tough. I think you can have a look on your own. I'll pause, leave it here for a few seconds so you can pause and read through. This is from the textbook. You don't need me to explain these. Good news. You can ignore 51 and 51A. 52 and 53. You can see previous slides about personal use assets, so we've done that already. Okay. Paras 54 and 55 speak about retirement benefits and life policies. Again, there are slides that or videos that I've put up about retirement benefits. What it says here, you can ignore any gain or loss from anything you receive as a retirement benefit or anything you receive as life insurance. Why is this? Well, they're taxed specifically in terms of the second schedule or in terms of life insurance as in a state duty, so you don't need to tax them again under CGT. Make sure you make this link or make a note here if you haven't done the slides yet on retirement benefits or you haven't done the videos and slides on estate duty. Awesome. Para 56. Para 56 is a very interesting one and requires a little bit of thought. So let's just remind ourselves where we're at. This is a situation where there's debt between two parties and those parties are connected. Okay. What it's saying here is that if two parties are connected and one person forgives the debt, okay, so by saying here, I'm pointing at my screen, but you can't see what I'm pointing at. Okay, if the creditor disposes of the debt claim, basically meaning if they forgive debt, we know how to deal with 12A on the other side, but for the person who's actually forgiving the debt, there's probably going to be some kind of a capital loss. You had an asset, somebody owing you money. It was capital in nature, it wasn't for trade. That's forgiven. You lose that asset, capital loss. Okay, but now what you have to think about is that because you're connected, that capital loss is going to be disregarded. It's going to be set off, and you can only set it off against a gain with the same person in the future. But now we have a situation whereby the person who's receiving the benefit is applying 12A, having the base cost of their assets reduced, so the bad thing is happening there. But on the other side, the person who is forgiving the debt is not being allowed their capital loss. It's being told that it has to be ring-fenced, clogged, disregarded till later. So the bad thing is happening here too. And the purpose of tax is generally that when a bad thing happens on one side, a good thing happens on the other, so that it's neutral. But in this scenario, both parties are getting something which is negative. So what this paragraph says is that to the extent that the other person applied paragraph 12A, the creditor may recognize a capital loss in terms of para 56. So what this says is if the other side is applying 12A, you can then apply and claim this capital loss. This para 56 overrides anything that speaks about having to ignore capital losses between connected persons. So as long as one side applies the 12A, the other side can have the loss. But if the other side doesn't apply 12A, you then can't recognize the capital loss. There's definitely an interaction between paras 12A, paras 39, and paras 56. This is always going to be the nice technical marks. These are going to be the kind of marks that separate, the average student from the top student, but it is something that I think you need to know, and it's definitely going to come into play when you get to GDA. Awesome. Para 57 is a specific provision that speaks about small businesses. So if you have a small business, what you can do, if it defines certain things, active business assets are defined as any immovable property used to the extent for business, and movable property which is used exclusively and wholly for business. If the market value of all your assets is less than or equal to 10 million, okay, a natural person can disregard capital gains when they dispose of their interest in a small business if they meet the following. Active business assets must be owned by way of a sole proprietorship, okay, or through a partnership, or you must own more than 10% of you must own a larger than 10% interest in a company's active assets. So you either have to be the sole proprietor, a partner, or you have to own at least 10% of that company's assets. You must have owned this interest for at least 5 years. You must be involved in the business. You must be selling it due to ill health, infirmity, death, or you must have reached the age of 55. And you must sell everything and realize all your capital gains within a period of 24 months. If you meet all of these things, basically the scenario is you are involved in a small business, you either own the assets or the shares which own the assets, you've been there for 5 years, you're involved, and you're retiring or stopping due to ill health or because you died, you're allowed to ignore 1.8 million of these gains over your natural person's lifetime. Okay, you may think this is just stupid. When are you going to ever come across this? Bit of real life information here. My wife's father, my father-in-law, retired, sold his business, asked me for tax advice. This is what was important, and I totally forgot that it existed, so I looked a little bit stupid. Okay, so no, this may come in useful. You can disregard a portion of the capital gains if you meet certain requirements when dealing with a small business. Micro business is something very different. That is a business that is smaller than a small business. It's found in 57A, and you don't need to know how to do it. So some good news there. Some other random paragraphs. Para 58 speaks about exercising of an option. We spoke about this before. When dealing with options, you ignore the gain or loss on the option. You just look at the underlying asset. Okay. Any natural person or special trust. Whenever you see the word special trust, generally it's a trust set up for a natural person who is disabled. Okay, just to basically provide for their needs. You can ignore any gains or losses as a result of personal injury or illness. So remember, we've spoken about when looking at capital or revenue. Let's say something bad happens and you lose an arm or a leg or something like that. The scenario, we always said, well, we're the tree. I'm doing a tree pose here, if you can see. If we lose part of that tree, our income earning structure is diminished. That's a capital issue. If we receive compensation for that, it will be capital in nature, but there won't be CGT. We can ignore any gains or losses in that respect. Para 60 speaks about gambling and competitions. You can disregard any gains or losses from gambling and competitions, okay, unless it accrues to a non-natural person or it's not within the laws of the republic. So if a company wins, that will be taxed. If it's an illegal gambling operation, it will be taxed. Now just remember, most foreign lotteries are illegal in South Africa, so they would not count here. This also doesn't count if you are a professional gambler, like a poker player, because then it will go in as gross income. I'll tell you a story there now. Para 61, collective investment schemes. That is basically when you have something like a retirement annuity, stuff like that. The scheme itself does not calculate gains or losses when they sell. The actual person who owns a share of the collective investment scheme has to do it themselves. What this means, okay, you only calculate a gain or loss when you dispose of your interest in your retirement annuity, not when your retirement annuity buys or sells assets. Awesome. Bit of a story. Para 60, I just want to see what the next slide is. Cool, let's slot this in. 62, you don't have to worry about any gains or losses on any disposals you make to a PBO or government, political parties, anything like that. So if you do that, you make a gain or a loss, you can ignore it. Interesting story. Gambling. Any foreign lottery is illegal in South Africa. So when you hear those radio ads about play foreign lotteries, if you listen closely at the end, what you will hear is it actually says you are not playing directly in these lotteries, but rather betting on the outcome of these lotteries. So someone in South Africa has made a lottery that just uses the numbers from foreign lotteries, and it's then approved by a local gambling board. It always says the Mpumalanga Gambling Board or the Western Cape, one of those two. That's what makes that lottery legal. in South Africa. Fun story to end.